All right. Hello, traders.
Hey, Blake.
Hey, what's going on? I wanted to say trading warrior brothers and sisters in the house. Dale's he's usually here. His internet actually went down. So that happens. He's gonna try to log back on and be back here in a moment. But I went to go grab my 14th cup of coffee this morning in the last hour. I'm just kidding. I went to go grab a cup of coffee and I came back and I'm like, hey, where'd Dale go? But yeah, I've been texting with him. His internet is down. So look, we just had the Bank of England make a decision on rates. We've seen a little bit of volatility in the sterling, and it seems like we're turning around right now. I'm going to defer to Kman since Kman is here. We're not going to get Ryan today, are we?
He's off. He had to get his kids back from rain camp here in
camp. That's right. He'd mentioned that yesterday. So, well, it looks like it might just be us three for now, right. Which we're obviously in good hands. So, Kman, what happened here? Why did the sterling just take a serious turn lower? Was something just out?
A couple of things. So on the announcement, it was like the majority was expecting a 25 BPs. There was a bit of a different vote that it was like 6-3. Two of the members voted for actually 50 BPs. So when it came out, yeah, that's wrong actually on investing. It's a 6-3 vote. It's not an 8-1 vote. Two voted for 50 BPs, 140. So initially, as it came out as 25 BPs, they were happy about inflation coming off. Cable went to test the 126.25, then jumped, I think, on the back of those 250 BP voters. Gilts were not wanting to take a direction too quickly, but now Bailey is in hidden words, perhaps. Well, the unhidden, the clear words is that they are data dependent, like all of us and all of the other central banks now, but also saying that he's pretty happy. He seems to be a happy camper about this inflation, and now the sterling is gradually losing steam again. But we have to, for a clear view and a clear confirmation that sterling is still going to be heavy, I think we have to break that 126.25 and gradually move into the high 125s, low 125s perhaps. Yeah, the gilts have started to move. So
yeah, it seems like the sterling itself is mirroring what's happening intraday, at least with the gilts. Like here's the 10-year, so, and here would be the 2-year. The 2 years obviously getting clobbered, but the 5, I think I have it up somewhere else.
I mean, if you don't,
I do not have it right now, but
no, okay. I mean, but you see the overall picture, right?
Yeah, there we go. All right, there it is.
See what?
Yeah.
See what I mean?
Yeah, it's ugly. It definitely ugly. The shorter term just absolutely getting clobbered right now. Yeah. All right, so that's happening with the cable, and I'm gonna say, Stelios, what do you have any comments here? I know you have a lot to say about the Bank of England. So any thoughts here?
Well, they did broadly what was expected. We're always saying it was going to be either a 50 and it's the end, or 25, and they opened the door for another 25, and that's what they've done. Interestingly, that one of the members voted for no change, and we had two for 50.
Do you know who it was, by the way?
The new woman, what's her name?
Megan Green?
No, the one that is going to leave soon. No,
sorry, the one that's going, not the new one. Yeah.
Oh, I was going to say Megan Green. She fight the grain. Okay.
What's her name? I can't remember. Anyway,
Dingra.
Yeah.
Dingra.
Yeah, no real surprise, and that's why we're not seeing that much reaction. Okay, yeah, the short-term rates are moving, but cable and euro pound are roughly where they were before. I've actually taken a small long in cable 126.39 because there's a pretty important zone around 126.20 to 30.
You see it? It's a 618 retracement, buddy.
Oh, is it? Okay. It's also previous highs, previous lows. There's a lot of traffic there. So you see,
Yeah.
you know, I like that for a little quick punt, and I have my stop below, you know, 26.09. I think I put it. So it's very,
Look at
it's
you,
very
day
tight.
trading scalper Stelios. When this guy, where'd this guy come from?
But overall, we got no surprise overall from the Bank of England. So not much more to say.
Okay, well, let's talk about everything else because there's a lot happening overnight. We've seen equities come under pressure, and look at the S&P. We've actually broken that 4520. You know, Kman, you were gone already for the evening in the ForexAnalytix chat room when I did this, but you know, the dollar Mexican peso closed at like 1701, something like that, and I was like, you know, it can't break 1705. I'm going to go ahead and get out of it. And then, you know, I was thinking about it as I was doing analysis, I closed it and I'm like, you know, we closed below the 45.25. I'm like, that's intraday. That's a bearish event. There should be some selling overnight. That was my thought process. So, you know, I jumped back in the chat room, told everybody, hey, look, I'm going to get long some dollar Mexican peso again, just silly as it is. And we got a rip roaring rally overnight out of the dollar mex right up into really key resistance. This is what's really critical now. But looking at the S&P, we are seeing some downside pressure. We are seeing some pressure not only in, you know, the S&P, but the DAX is, you know, kind of falling apart this morning. We even got the Nikkei rolling over. What do you make of this move in risk assets? We're seeing a little bit of weakness here. Are you gonna do you think it's gonna continue into tomorrow, or at least ahead of tomorrow with the non-farm payroll?
I can see ahead of tomorrow that there's a bit more to be done, possibly. It all happened at the opening of Europe because Asia was relatively quiet. If you look at Asia, actually, the dollar yen was trading around the high. The rest of the dollars were still relatively bid, but quiet down. And then all of a sudden at the European Open, the stock markets, the equity markets got a serious hit on the head because it was a global phenomenon, and that dragged the carry trades. But there was a bit of carry trade in there as well, unwind, I think. So the dollar mex ran through this 170506. Dollar yen turned around, lost a big figure, and S&P went for a test below 45, and was a bit of a global effort from the market selling risk pretty heavy. It all lasted for about an hour, and call it rush hour to get to the office, and since then it's quiet down and more concentrated on what was going to happen for the Bank of England. But we have to note that stuff like, for instance, dollar rand is not coming off much. Dollar mex is not coming off much either. I think we have to watch 1740 there. Yeah, and we went very close in stuff. We talked about it in our chat room, Blake. Euromex to a decision level around 19. We're in for interesting times. Now we need to see, and I reckon there is a possibility that at the New York Open we got another attempt to the downside, and then we will need to see what happens. If the equity markets stabilize and start to grind back higher, it may all be over for now, but we will have to see.
Let's not forget, guys, we have Apple and Amazon earnings after the close today. That's one of those things that you know, we obviously got to watch pretty carefully. I'm gonna just pull up those charts. As you can see with Apple, we are coming out of an ascending wedge. It's important because this is a bearish reversal that we're already seeing. You can see pre-market we're down slightly, but more importantly, just kind of seeing how the consumer is reflected in Apple. because it's such a popular, you know, especially like the iPhones and iPads, and you can get kind of a taste on what's happening with personal computing with Apple. But with Amazon, it's really a global, sales force now. It's not a US based company. I mean, it is US based, but look, Amazon's everywhere. It's in the UK, it's in Australia, you name it. It's in a lot of places now. So Amazon's a great heartbeat on like the global consumer. Sorry, guys, it's still 5 o'clock in the morning. I can't really speak yet. But we have a nice head and shoulder pattern that's developing. This is something this was actually a setup for the trade-off that I did last night with Chris Weston. But you got to watch Amazon. The Amazon, Apple after today. I mean, we could wake up tomorrow morning and theoretically we could see rainbows and unicorns, and we could see Apple and Amazon gapping higher, stocks recover. The S&P rallies right off of channel support that you see here, which is, a strong possibility. The flip side of that is we could wake up tomorrow morning after, the earnings, and we could be gapping down a percentage or more. And in all global markets, if Amazon and Apple both disappoint. So I think this is going to be really important for the market. And think about that ahead of a jobs report, not only out of the US, but out of Canada as well. So we have some really important next 24 hours happening, and we'll be covering non-farm payroll for you live here tomorrow morning. So make sure you all are here as well. Stelios, what's your how are you feeling?
What's my view on equities?
What's your view, not on equities, on everything? What's your view on life? Tell me,
First of
what's
all,
happening in the world.
First of all,
Yes.
I said yesterday, the reaction of the dollar on the US debt downgrade was a bit strange. Usually it's not dollar positive news, but that's what we saw. I think we're seeing a positioning unwind. So we've been talking about it for a couple of weeks, right? That the market was very short dollars. Everybody hated the dollars. Similar way like everybody hates the pound right now, or close to. And a spike was always on the cards. I think this is what we're seeing. My main view remains that yields are going to be, yes, we are breaking out a little bit here on the 10-year, but I think this is the last hurrah for yields. I think we're going to be going lower. And there is a reason for that. First, central banks are pausing or stopping. Secondly, inflation is dropping. I'm not saying we're going to go and see negative inflation, which means that things might go somewhere back to normality, but I think the rate of change of inflation is dropping and is probably going to stay low, at least for the next 6 to 9 months. After that, who knows? So with a combination of these two things tells me that yields are going to find the top somewhere here or close to. And the reason they're breaking out, I think, is driven by the dollar. Go on.
And I was going to say with yields, and I mentioned you on the trade-off last night with Chris Weston. I said, hey, my colleague Stelios, he was talking to one of his buddies about yields, thinking that, and looking at it last night. Now you can see yields continue to press higher. This is a bullish wedge, by the way, or you can look at it as a, cup and handle pattern, which is not bearish, by the way, but bonds, I thought we might get a little false breakdown, but we are continuing lower today. Why do you think, and I'm going to ask you this, why do you think that bonds can't go lower from here? Well, I mean, why can't they?
Well, because I think that, as I said before, the combination of central banks not tightening anymore and inflation being lower means that monetary policy is not going to tighten. If anything, I think the Fed is a lot closer to reversing and maybe, tinkering with their QT schedule and eventually buying more bonds, which I think they will.
But I see this downgrade. I'm hearing what you're saying, Stelios. I see this downgrade, and I don't want to. I'm actually going to sell. I'm going to sell bonds because
go for it.
No, I'm just saying as an investor. Now, this is what people are thinking. Like, I don't want to own U.S. government bonds right now because they're getting downgraded. What if they get downgraded by Moody's or S&P?
Well, if you own government bonds at 4+%, why? What is a downgrade? What does it scare you? Because basically what you're doing is you're getting yield. The thing you should be scared of is a default. I don't think the US will ever default. So that's not the worry. I think there's a lot more it's a lot more attractive now to actually be locking in yields. And
guess I 100% agree with that.
Guess who's been buying bonds? That he announced it today. He's been buying for the last couple of weeks, and he's going to be buying more next week. Warren Buffett.
Jamie Dimon?
Warren Buffett.
Oh, Warren Buffett did. Okay.
So when Warren gets in the game, it's something that interests me. So I'm not saying bonds are going to turn now, right? I still think we might even try to break that 430 level, which I don't think is going to happen, but we might get to that.
And by the way, I'm playing devil's advocate because I actually think that's the right play. So me personally, I think it's the right play. What about you, Kman? I mean, yields are at these levels. Do you find them attractive? If you're if you're a portfolio manager, I know you do a lot of trading on your own and, do some unique things, but let's say you're a big portfolio manager, you've got, 700 million under management. How would you view debt right now, U.S. government debt?
Yeah, I think it's very attractive to at least place a part of your money in there, and also don't forget that people have been short bonds for a while as well. But then, sure. And I think there's going to be liquidity even without the Fed. I reckon for the Treasury issuances, because there's so much money still in the reverse repo and in the money market funds. There's going to be some decent liquidity, but I wouldn't think that like if you talk about downgrades and if you well, first of all, Fitch, I think it's like the local bank crisis. It lasts for a while, and then I think it's already out of the market, or at least if it doesn't get accompanied by other rating agencies, it's probably going to remain as it is. But I do think with the Treasury increasing their issuances in months, which they have announced this week, the yields will have a tough time to come off a lot, unless we see those last dominoes, which are the jobs market, etc., starting to fall. I don't see why yields would come off actually right now. And on the question of QT, Powell was relatively clear that even if yields are at the top, and even if they would start to come down, they could still continue to do QT. There's still a massive amount in the Fed's balance sheet, Yeah, it's gonna be on a big downturn that they are going to stop QT for now. They really want to screw it back, in my opinion. So yeah, I don't see yields really drop fast if it's not accompanied by a kind of recession right now.
All right,
guys,
go ahead.
The U.S. government, they have this problem. Okay, 120%, north of 120% debt to GDP. They're issuing record amounts for the second half of this year. They just announced it a couple of days ago. And if I recall correctly, 15 to 20% of new issuance goes to pay coupons of existing issuance. So this is not sustainable. So these yields cannot stay here for long. That's the problem that the Fed, the Treasury, everybody has. That's the problem. They need to get rates and yields lower. How are they going to do that? Not by selling everything they have. That's the problem. So I'm with you. But Powell has been saying we need to keep going and QT and this, but you know how these things turn, and I think there's going to be loads of pressure on them to stop. I hope I'm wrong, because really they shouldn't. But yeah.
Well, okay. Let's switch gears a little bit and let's talk about what's happening in precious metals, because precious metals, we have gold sitting right on key support. I mean, I feel it's very critical. I have to point out that, we're sitting here looking at gold, and I have to ask you this question from now. And this is, somebody who's got gold, not as a trade, but as an investment. But I'm gonna take the stance of a gold bug. Okay, I'm a gold bug. I think that gold's gonna eventually break higher. What else can you possibly give me that hasn't been given to me already at this stage in the game? I mean, we've got inflation, like, well, you know, it's an inflation hedge, or at least it was, you know, for that was Goldbug's argument for many years. We've had this you know, constant Russian Ukraine rub going on. You know, you've got the dollar basically collapsed this year, and gold's just kind of sitting here. I mean, what's going to get gold moving again? What do you think?
I kind of disagree with that, because think about all the tightening that's happened and gold is sitting there. See, that's the thing. Gold is an inflation hedge, but not a short-term inflation. It's not an inflation hedge when CPI is increasing. It's an inflation hedge on the traditional definition of inflation, which is the change in money supply. If you plot gold against M2 money supply, it's a 0.9 correlation or something like that. So in the short term, gold is not an inflation hedge, because rates go up, which means, oh my God, we need to sell gold, right? So I will argue the other way. And by the way, I think we're going to be breaking lower in gold and testing that 1895. That's how things look in the short term. But in the last 2 years, what's happened in the global economy and in rates? I mean, they've gone through the roof. And gold is just sitting there, been $100, 100 and something bucks below all-time highs. If you ask me, that's a pretty resilient performance. Same with equities.
Right.
So there's arguments on both sides. That's the thing. And I often look at the arguments to the downside as well. And as I said before, I think we will be breaking to the downside and testing that 1895 just in the short term.
In one word, liquidity.
Yeah.
Sorry, guys. I'm just I've been texting with Dale and stuff while you guys are talking. If you think I'm not paying attention to what you're saying, I'm not, because we have Jamie.
I think it all comes down to liquidity, because if there's enough liquidity in the system, those kind of instruments will hold, and also the fact that the market is pushing, or has to push back against recessions as well, because everybody was saying 2023, that's it, we're going down the drain, and we are August, and we are still quite comfortable for the time being, at least, just above, not really economies that are roaring, but we are not in a recession yet either, and all those instruments benefit from it, right?
They do.
Despite higher rates.
Hey, I'm sorry. We've got weekly unemployment claims coming in just about 10 minutes. We have Jamie McGeever from Reuters. He'll be here today. So I think I'm going to end up doing an interview with Jamie. I like him. He's awesome. He's a great reporter over at Reuters, and he comes on our show every once in a while. So it's really, you guys make sure you stick around, because he's going to have some few words to say about where he thinks what he thinks the next steps for the Fed are, and also the ratings downgrade with Fitch. I think he's been through a couple of cycles with upgrades and downgrades. So make sure you guys stick around for Jamie McGeever from Reuters. But before we do that, I want to talk a little bit about where we are with economic data. We have weekly unemployment claims today. I think the more important piece of data is going to be the ISM data that's coming out. It is the ISM services data that's going to come out in about, what is that, an hour and a half from now? Kman, since you were just talking really quick, what do you think? Where do you think we're at as far as data goes and positioning with with like the market? Because I was talking to one of our traders in the chat room yesterday. This is the COT euro chart, just so you can see what's happening with positioning in the euro, and you'll see that there's so much speculative money that's very, very long the euro, and I think a lot of them has been liquidated this week. If you've seen the move in the euro from above 110 to where we're at, that number's obviously gone down throughout the course of the week, because this is reported on last Friday and as of the previous Tuesday. So we're talking 9 days ago. But 9 days ago, the market was pretty lopsided long euro. So if you wonder why the euro continues to slip and the dollar continues to strengthen, I think that's probably a good, one place that you can point to. But we're pricing positioning even out a little bit over the course of the last week or two as the euro's been sliding. I think there's more to come. But based on how far the dollar has gone, how are you gonna trade the dollar from here? Because I think the dollar is, I look at it as it's a little too strong to be shorted, but it's gone a little bit too far. It's gone a little bit too far to be bought at the moment. So it's kind of like I don't want to stand in the way, but it is gone a little bit far at this point. How are you thinking about the dollar and economic data over the next 24 hours?
Well, I would agree on that. And we know that there was, and Stel already said it as well, there was a lot of short dollar positions in there, long other currencies. They have been more than likely managed and rebalanced. And now I guess we are waiting. And then after the ADP, we got this acceleration. Now I think we are really going to wait. The claims today, we've seen this spike up in the 260s for a while, and then now it's back in the 220s. That, unless we get a big surprise, there shouldn't be a mover. The ISM for sure is going to be watched. Watch those prices. Watch what's going on the employment side as well. We're hovering, expected to be just above the 50, but if the employment index starts to drop below 50, we may find it a little more difficult for the dollar, perhaps. I think we're pretty much balanced here. What the dollar is concerned. And then tomorrow, the labor report with the wages, with the imbalance that we saw in the last labor report between the government and the private sector, that is going to be watched as well. I'm going to go open into the numbers with an open mind right here and now, and watching those imbalances. The risk trade is for a disappointing report. That, I think, is going to be a bigger mover than when it comes to the right way. But the immediate trend in the market is for a bit stronger dollar based on those yields, based on probably treasury and stuff. So that's going to be the slower grind if the report continues to be good. The speed trade will be a weak report.
That makes a lot of sense. I mean, everybody's like accustomed at this point in time to strong, data, or the U.S. economy is faring better. It's the least dirty shirt in the closet right now, and we I think most people, myself included, aren't expecting a turn lower in labor at this point. Maybe maybe over the course of the next couple months, but not necessarily today. So you're right. I think that the disappointing number would provide more of, and disappointing data just in general today and tomorrow is going to provide a little bit bigger of a oomph. Hey, Stelios, we got about a minute before the data comes out. What are your thoughts here?
Yeah, regarding the dollar, I agree with Kay. I am looking at 103.50 on the Dixie. 103.30 to 50. I already actually took a small long in cable this morning, 126.39. And I plan to run this into tomorrow if I don't get stopped out. My stop is relatively tight. But for the euro dollar, so I think we will likely test that 103.30, 103.50 area in the Dixie, whatever that makes the euro dollar. And that's where I want to get long euro dollar. But the moment I'm sitting tight just with that one position, and of course my silver as well, but that's a different story. So we have a minute to go.
We do, and what we've got here, guys, this is the data flash. It's in your ForexAnalytix system. You can pull it out of there and extract it so we can get the data just as it comes. Or we have jobless claims that we're going to be watching. But I have a chart on yields over here to the right, S&P in the middle, and we have the dollar index, right over here to the left. It's going to be, we're going to get instant reaction, but remember the big data today is going to be the ISM services as Kman. Everybody's going to be watching that employment number. I think we just saw that the number, people are expecting 51-ish. So anything below that's going to be kind of ugly. That's, let's we have the data coming out in let's see how many seconds, about 10 seconds, guys. So stand by. All right.
Let's see what we get. Labor cost is weaker, non-farm productivity is higher.
The dollar index is coming off a little bit.
Jobless claims I don't see yet.
I don't see yet either, so I'm going to pull that away. And
227 as expected.
As expected, yeah.
As expected.
Yeah,
okay, I wouldn't get.
Yeah, it's those labor costs are coming off.
The jobless claims, 227,000 in line with expectations.
The labor costs, so that's what's really going to affect right there. Yeah, you can see it right there.
Yeah, but the
So,
productivity is better.
Yeah. I mean, you know, that's but I think that inflation narrative is the problem. And you know what? I have somebody here that Dale brought in that is probably going to talk a lot about that. And Jamie McGeever is here. Hey, I want to say thank you, Kman and Ryan and Stelios. Sorry, I'm used to saying Ryan, but he's not here today. And as he went to go pick up his kids from camp, Stelios, Kman, thank you guys. Keep rocking on the Flow Show. And if you guys aren't tuned into the Flow Show, if you're up trading during European hours, you should be tuned in to Ryan and Stelios and Kman every day, because they get you prepared for the trading day in Europe. And you know, make sure you catch them there. It's a free show. Find them on the ForexAnalytix website. So thank you, gents. I appreciate it.
Thank you.
All right. And Jamie, welcome to the F.A.C.E show. Dale's not here, but you got me, and I can't go on camera because my hair looks like, I look like one of those troll dolls that you put on the end of your pencil. That's how I look this morning. So how you doing, sir?
I'm very well, thank you. How are you?
I'm doing good. Dale's running with a power issue. He lives in California, so sometimes I think his grid gets a little overheated there, and so I think it's being affected this morning. But I didn't want to take away from having you here, because first of all, I've never had an opportunity to meet with you, but I've been reading your work for so many years on Reuters. Tell us what you're thinking right now as far as, you know, the heartbeat of where global central banks are at. Are we at a high, first of all, for rates globally, but secondly, are you a believer, and I'm asking you personally, are you a believer that central banks are here to pivot soon?
Well,
I mean, okay.
I think that's the question du jour. And first of all, get my disclaimer in, as a reporter for Reuters. I obviously don't have an opinion, don't have a personal opinion. That's the official line anyway. But yes, I think it's safe to say that peak rates, if you like, is well within sight. I mean, I know we've been saying that for maybe 6 months, possibly longer. Certainly, if you look at market pricing, Fed futures, Fed funds futures, and SOFR markets, they've been pricing in a pivot or a pause or a combination of the two for, I think, about 1.5 years now. And it's no different now. Looking at the 2024 strip, we're looking at 100 to 125 basis points of cuts priced into the curve. Don't fight the Fed is the old mantra. The market's been doing that for, as I say, well over 1 year now. And guess what? The Fed has held the line pretty well. I think it's safe to say we've had more rate hikes than most people anticipated, and certainly more than the market anticipated. And we are where we are. But after 500 plus basis points of hikes in about 18 months, you would have to think, I mean, it's stating the obvious, we're closer to the end of the cycle than the start. But the commentary from the Fed is still, holding the line. The Fed policy seems to be just keeping the market at arm's length, hanging the possibility of one, possibly two more hikes over the market, just so that financial conditions don't don't loosen too much. Because I think if once we get the sort of green light that the Fed's done, you can see a scenario where financial conditions loosen quite a bit, because we will be at peak rates. And then the next step after that is obviously how long does the Fed stay on hold, and then when does the easing start? What's my personal opinion? I think we're getting close. I think the signaling from the Fed is that they are close. However, they just want to keep maybe on hold for the rest of the year and 2024. Although Powell did say, I think, did he not say last week that he doesn't see rate cuts really until
I thought that was probably the most interesting thing of the Fed, like, the meeting, because the market's been pricing in rate cuts at some point, going into 2024. And when he specifically says, look, we don't see, and he said, we don't see a recession. I mean, that really, when he says a recession, that means if I'm the market, I got to cue off that and say, wait a second, that means there's no cuts coming.
The soft landing stuff has been quite fascinating. I mean,
yeah.
I think I would have to hold my hands up in a mea culpa. I mean, I was skeptical of the soft landing scenario. Perhaps it won't turn out that way, and these things have a habit of creeping up behind us and biting us where it hurts. But so far, the signs are remarkably that there is no recession on the horizon. Just look at the GDP numbers, look at the Atlanta Fed forecasts. They're pretty punchy. And some of the indicators, I mean, we've been speaking about them for months now, months and months. The yield curve, consumer confidence, all the bank lending, etc., all the traditional indicators, red flags of recession warning, which we've come to know and trust over the last 30, 40, 50 years, especially the yield curves. They just, so far at least, they're not playing out as we've been led to believe they would play out. That's not to say that the long and variable lags, don't come up and turn out to be just exactly that, lags. And I think that's an interesting point. I mean, we've got Fed Governor Chris Waller. He's of the opinion that the lags now are much shorter. So you're looking at maybe 9 to 12 months for policy to come through and affect the real economy. If that's the case, much of the tightening that's been done by the Fed has already been felt or has filtered through to the economy. If that's the case, we have maybe 150, 200 basis points worth of tightening still to come, but we've already had about 350 basis points of tightening that's already played out in the real economy. If that's the case, the economy's held up pretty well and there are no recession signs. However, if you think the long and variable lags are a bit longer, 12 months to 24 months. I think Milton Friedman's was about 18 months.
Yeah.
Then we've got more pain to come, and so recession could happen. But so far the signs are there's no recession, and if that's the case, the Fed must be pretty comfortable. And I wrote a piece a few weeks ago saying that if, and it's again a big if, big caveat, if there's no recession, if there's a soft landing and no recession. And there's only been one of those in the last 50, 60 years, according to Alan Blinder, one pure soft landing where there's been a Fed tightening cycle and no recession. That was in the mid-90s. If we have another one, could Jay Powell go down as probably the most successful Fed's chair of all time?
I think that's what he's going for, right?
Well, I mean, you have to take your hat off. If, again, it's all caveats and hypotheticals at this stage. If we get through this with no recession, it's pretty remarkable. And I think that would speak to the sort of post-COVID economy, if you like, not just here in the States, but worldwide. I think all the models and sort of things we've been led to believe and expect and trust over the decades, all of that is now thrown into question.
Jamie, I'm going to ask you a question. How long have you been reporting for Reuters now?
With Reuters, nearly 20 years, and I was with Dow Jones for 6 years before that. So about 25 years all in. So
you and I, and I've been trading for 25 years roughly. So you and I are right in the same boat pretty much. So you've seen it all. Well, not all. I mean, we weren't around when inflation was raging back in the, even though we were probably, both of us were kids, we weren't around when like trade or looking. I could care less about what was happening at the markets when I was 10 years old. And probably either. But or maybe you did. I don't, not me. But if you go think about like what's happened, it's been such a remarkable quarter century, I would say. Especially you've seen, the monetary policy that has really gone through the markets over the last 13 years, roughly, since the financial crisis. I take a step back and look at, like, I think I have a chart here. Let me see if I can pull it up. Oh yeah, here's the Fed's balance sheet. Just, since 2003, you can see that the response function of the Fed post COVID is triple that of what happened during the GFC, or the Great Financial Crisis. So, with that information in mind, you have to take a step back and go, and I agree with you. If the Fed chairman manages to pull off a no landing, or we have to give a hat tip to him. However, the reaction function of this right here that lag theoretically could end up being 2 years or more. So I think you run into the issue where if you're George Bush Jr. and you put a mission accomplished signage on a battleship, that might be the same situation that we find ourselves in if the Fed claims they've won a little too early. And I think that's going to be the real interesting thing over the next 12 months, I think, in 2024. Wouldn't you agree?
I would go along with that, certainly. And I think the last people on Earth who will be putting out the mission accomplished banners will probably be the Feds and the FOMC members themselves. They will not want to be too hubristic or presumptuous at all.
Right.
But however, that chart is a fascinating chart. I would just say a couple of things to that. Of course, that's in pure dollar terms, but I think you have to look at that chart as a share of GDP. And of course, it's a larger share of GDP now than it was back in the early 2000s, pre-GFC. However, it's not. It's a far less alarming chart, and I don't have it in front of me. But if you look at that as a share of GDP, it's far less alarming and much more manageable, if you like. And certainly relative to history, it's nowhere near as stark as that. And it's also it's again relative to other G7 central banks and countries. It's not quite it's nowhere near as alarming either.
There's definitely other central banks that have done more. So
much more. Of course, we're here in the States, we're talking about the Fed, and the Fed's the biggest and most important central bank in the world. But the ECB, for example, has done more as a share of GDP. And you don't have to talk about, not to mention the BOJ, although I'm sure we will. The BOJ has been doing this for, we're talking 25 years in the business, probably as long as that, if not longer. The BOJ has been expanding its balance sheet. And I think, I don't know where it's at right now, but is it over 200% of GDP, over 250%?
Something crazy like that. And yeah, Japan is its own crazy animal, isn't it? I mean,
it is indeed. And you're talking about when we started in this business. I started in 1998, and my very first week on the job was LTCM.
Oh my God, get out of here. Really?
So that was a
baptism
of fire.
Oh my God!
I was absolutely. I didn't have a clue what was going on, and some might say I've not learned much since then. But yeah, I mean, and going back to talking about central banks, the Bank of Japan, obviously back then was heavily involved in the market, intervening in FX, and not much has changed over the years. The Bank of Japan is probably the most market savvy or market active central bank. Or major central bank in the world, and the BOJ balance sheet is absolutely ginormous, and yet they've been battling deflation, as we know. Of course, that's starting to turn. Okay, they've not had much growth, or they've had slower growth over the decades. But to the question of the Fed balance sheet, can it stay at high levels and as a big share of GDP? Yes, it can, unquestionably. Obviously, the Fed has the US dollar, the world's reserve currency. Everybody wants to be in US markets. So there's no issue for me in terms of, or there's no real issue in terms of the Fed balance sheet, either nominally or as a share of GDP, which sort of touches on the Fitch stuff this week, the downgrade. Maybe that's a bit questionable, certainly in terms of timing, but the US ability to cover its debts, to pay its bills, and to pay its way, or to attract inflows or capital, for me, that's not in question. Although the level and price at which all that happens can be debated, but the Fed balance sheet, yes, it's an issue. But I would say the BOJ balance sheet has been an issue for 30 years or 20 years and counting. And
they also have a structural, demographic issue too.
Of course,
I mean, there's so that Japan is definitely a different market. But
go ahead.
Go ahead.
No, and as you say, demographics and the share of domestic investment or domestic holdings of the bond market, etc. Is very different.
Very different.
But
I wish we were more like Japan in a lot of ways here in the US, but we're not. So, but there's a lot of ways we're not similar, which is also a good thing. But hey, I want to ask you this. Since we're talking a little bit about different central banks and looking at what the BOJ has done, do you follow? Are you following what the BOJ and Ueda is doing over there?
Yeah, I just did a piece. I think it went out yesterday, in fact, on the latest policy move from the Bank of Japan. I don't.
Yeah, I'd love to get your thoughts.
I don't follow it as closely as I did when I was covering FX back in we're talking about early 2000s, mid 2000s, when the Bank of Japan was very active in the FX market, intervening to sell the yen. Of course. Did you write
a lot about Mrs. Watanabe as well?
Oh,
the carry trading ladies?
More than I care to remember. But it's actually it's a fair point, and it's a bit of a cliche, but it's a fair point. I mean, Japan is the world's largest creditor.
Yeah,
they have Japanese investment base, including institutional and retail, has some $4+ trillion worth of bond or debt holdings overseas. Nearly $2.5 trillion of that is in portfolio instruments. So there's a huge amount of money, Japanese money, abroad, much of it in the US, much of it in US bonds and on Wall Street, that potentially could go back to Japan if interest rates become attractive and if bond yields become attractive enough once hedging costs have been taken into account. Right. And the BOJ move last week is, I think, is very important, just as the one was at the end of last year. They're obviously wanting to normalize policy. They want to raise the level at which yields can go. It won't happen overnight. It'll be a sort of longish process, and there'll be bumps along the way. But I think it was a big move. And once, if the Bank of Japan is convinced that the battle against deflation, the generational battle against deflation, has been won. We're talking about mission accomplished banners, but if the Bank of Japan can safely believe that it's won the battle against deflation, it will allow yields and rates to rise. Yields first, then rates. Don't forget, Japan still has negative interest rates. But I think the Bank of Japan's move was well timed. We're talking earlier about peak rates globally. If peak rates have peaked globally, and we're starting to come over the hill now, and central banks, the Fed, ECB, and BOE are looking at next year cutting rates. I think that's a good environment for Japanese money to come home. Global rates start to come down, Japanese rates start to rise, and there'll be a lot of demand for fixed income assets globally. I think the Bank of Japan's timed this pretty well, and also this symbolism of it all. Japanese inflation, if you can believe it, is higher than US inflation on a headline CPI basis.
That is the craziest thing, right?
And it's the first time, I think, in 8 or 9 years that's happened, but it doesn't happen very often, but it's happening now. And, if you think US inflation is starting to ebb, I know the last mile is the hardest mile and all that, but we could have a 2-handle on US inflation pretty soon. And so, I think the Bank of Japan has played this one pretty well so far. And I think the market reaction shows that. Volatility, FX volatility, bond market volatility fell after Friday's move. Okay, Japanese stocks have taken a bath a bit, but I think that's, don't forget, the 2 weeks ago, they were at the highest in 33 years. So they were bound to come down at some point.
Right. It's amazing. This could be like, and this is why I think FX traders right now are currently focused so much on the the BOJ is because this could end up being the biggest trade of 2024, 2025 is a big, convergence trade as the BOJ normalizes policy and tries to catch up. And then you almost get a divergent trade if people really believe rates have peaked and they're going to come down, which leads me to my next question. But I really want to ask two more questions from you, Jamie. I appreciate your time. But first question really quick. When you are thinking, peak rates, do you think, based on what the information that you have and who you've talked to, do you think the Fed or any other central bank for that matter is really going to be cutting rates anytime in the near future? I mean, they're going to need some probing and prodding. As you just said, it's going to be a little too early to claim victory, but what would trigger a response from a central bank to say, hey, we got to cut here?
I think I can't remember the exact numbers, but again, going back over the last 20, 30 years, the average time between the Fed's rates reaching a peak and the first cut, it's shorter than you think. It's a very, very short time on average. Obviously, sometime I think in the mid 2000s was it where I think Greenspan held rates on hold for about a year plus 18 months. But on average, it's actually very, very short. It's a matter of months. So if the Fed has one more hike left in it, I think it's September, is it? End of September, the Fed hikes once more as market is pricing. It's not unreasonable to think that the Fed could be cutting rates in early Q1, Q2 next year.
Yeah.
Even though Powell himself has said he's kind of pushed back against that, and I think I think the Fed rhetoric will be pushing back against that because, as I said earlier, once the market has that bit between its teeth, financial conditions will go the way that the Fed doesn't really want them to go.
Right, and it's interesting because I think the way that that people view this and the market should view it based on history is, well, the Fed's going to raise rates and they're going to keep them high until they break something. When they break something, they're going to have to lower rates. But we are in a different environment than we were, 10 years ago, 15, 20 years ago. And this isn't your dad's or your mom's Fed or your grandparents' Fed. This is a different Fed. And we're in a different environment, right?
Very different environment. And that's why I said earlier, I think all the rule books, models, and what we thought to be true in economics and markets and reaction functions and central banking has been, I think all that's been thrown up in the air, first of all by the GFC, but certainly by the COVID pandemic. This inflation burst and supply chains, it's the stimulus that the Fed and others put into people's pockets, household savings, how all that interacts.
Yeah.
Really, I think I wouldn't be going out on a limb to say that nobody really has a clue. And I think,
I think you're not going out on a clue.
And I would include policymakers in that. And I know maybe some of your participants and viewers might think, well, plus ça change and all that. But I think, nobody really knows how this plays out. And I think that's been evident by the way the market's been priced. If you said, I think, at the start of the year, if you said on January 1 that everybody thought this was going to be the year of the bond, equities were going to take a bath, and the dollar was, going to go down, which it has a little, of course, all that's been turned in its head. Bonds are flat, stocks are soaring. We've had all this tightening. Tech is up 30%. Big tech's up 75%. None of this was in anybody's forecast. None of it.
Yeah.
So I think that goes to show that we are kind of flying blind, flying by the seat of our pants. And as I say, that includes the Fed. So it's very, as Powell said last week, they're very much data dependent and going from one policy meeting to the next. I think that's the way we have to play it. And so pricing up 125 basis points of cuts next year, okay, previous cycles in history would suggest that's not an unreasonable bet, but the last 2 or 3 years would tell you that it doesn't pay to look too far ahead. I think we can be blindsided.
Yeah, right. You're throw out your models. They may not work. Hey, Jamie, I want to thank you for your time. One last real quick question. Fitch, do you have any opinions there? What do you think about the ratings change with the US?
It's a weird one, isn't it? I mean, again, we're talking about the Bank of Japan, etc., and balance sheets, and I think the timing is to be questioned. If this had happened before the debt ceiling deal was done, and when that was, bubbling up into something of a frenzy, and people were talking about default and all that, if this had happened then, you wouldn't question it.
Yeah.
But I'm not quite sure. I'm still not quite sure why they chose to do it when they did.
Well, I forgot that there's a Hunter Biden probe right now, and Trump indictment. I forgot about all that because I'm thinking about Fitch. So maybe it's just a little bit of diversion, right?
Diversionary tactics. Nobody's ever used them before. But
never.
But just on a semi-serious note, I think if I remember correctly, the debt ceiling deal pushed out. It's suspended it, did it not, until January 2025? Is that right, or March 2025, which is after the election? And if my maths is right, it's about 18 months from now. So we're we're on terra firma, we're on safe ground from now until early 2025 as regarding the US government's ability to pay its bills and to borrow, etc. I'm not quite sure why they did this. Yes, borrowing's rising, debt's rising, and the amount of auctions is going to rise, and we've seen the curve steepen. The long end doesn't like it, but I mean, don't forget, we've got the most inverted yield curve on any measure for about 40 years. So I mean, don't people want the curve? Don't people want the curve to steepen? Isn't that part of the game plan?
Yeah, I mean, we don't want it to continue to invert, right? So
again, I mean, that's but even if it did invert, what signal would that be giving us? What can we take from that? I mean, if it's 100 basis points inverted, or 120 or 130, we're in territory that we've not been in for 40 years or for decades ever. Yeah. And yet, markets seem to be bumbling along okay. Demand for treasuries is still pretty strong. And just talking of Fitch and the downgrade, we've seen Warren Buffett come out, I think today or yesterday, saying his firm's buying billions and billions of treasuries. Doesn't see a problem with it. And obviously one of the weird ironies of any US debt scare is that people pile into treasuries, and that's happened in the past. I don't think that would be any different. And when you're getting 5.5% for 3 or 6 months borrowing from the US government, why wouldn't you take that?
Yeah, I mean,
and you're getting 4%
that's the thing.
It's for 10 years.
Total safe haven play at this point. It's like, okay, well, where else am I going to park my money? And do I really want to be buying risk assets up here? It's a crazy world we live in, Jamie. And I want to say it's been a wonderful, just having a conversation with you. I really respect what you do with Reuters and you as a journalist. What's the best way for people to follow your work?
I'm on Twitter, or I think they call it, was it X now? Or
X, whatever it is.
At Reuters Jamie on Twitter, and I obviously I'm a columnist for Reuters, so all my stuff appears on the Reuters newswire, and most of it goes on to Reuters.com and is picked up by other media around the world. So yeah, at Reuters Jamie on X or Twitter, and the Reuters website. So
when's Elon Musk going to get when's he going to find himself in some legal battles regarding X? It's got to be coming soon, right?
I don't know. I mean, I think I wouldn't say I was one of the early adopters of Twitter, but I joined in about, 2011 or something. I think that was when,
2011. It's quite some time.
Yeah, it's and it was the place to be for financial commentators or analysts, or the FinTwits and all that.
Yep.
Certainly, I think it's safe to say, again, not going out on a limb, it's not quite as rewarding or as good a place to be now for the financial community as it was back then, or even any time in the last 10 years. It's lost its luster, I think. And,
it has, but you know, I've been here since I think 2009. Let me see if I can, you know, go. Yeah, 2009 I think is where let me make sure I'm correct. Yeah, 2009. I'm looking at it. And I'm with you. What's that?
Early adopter.
Fairly, but I agree with you. It's not like our it's not what it used to be. But if you look around, it's hard to find something to compete, regardless whether it's X or Twitter. So, but Jamie, I want to say it's been a pleasure. I'd love to be able to chat with you again, and you know, thank you for spending your time with us. I know it's very valuable to you. So thank you for spending it with the ForexAnalytix community. I appreciate it.
Thank you very much for having me. All the best. Have a good day.
All right. All the best to you, Jamie. Take care.
Speak soon.
All right, guys and gals. I'm going to be wrapping it up here for Dale. Dale had reached out to his provider, and he has an outage in his area. So Jamie, he'll be reaching out to you again. So
look forward to it. All the best.
Right. Thank you, guys. All right. Have a great day, everybody. Good luck. And we'll see you tomorrow for non-farm payroll live right here on the F.A.C.E Show.